What we have seen, particularly as the Fed has kept rates where they are and had raised them beforehand, that the dollar has maintained, for the most part, a fairly strong relationship to other currencies. But that is just merely from the standpoint of looking at baskets of currencies relative to baskets of other currencies, the dollar relative to the euro, dollar relative to the rand, and so forth. It doesn't really take into account where the growth in trading partnerships has been accelerating outside of just dealing with the United States. So areas in Southeast Asia and China working together, Japan and China working more together, Brazil and India and China working more together, and so forth. You've had this expansion of the volume of global trade across the world outside of the dollar. So in that respect, the dollar has actually lost value that doesn't come up when you just look at currency baskets and ETFs, the dollar exchange value. Now, is the dollar going to go away? No, but it has less of a percentage right now in central bank reserves. The Chinese have, for example, only been buying pretty much the same amount of U.S. treasuries as before, yet we have a whole pile more of debt. So they're still at their $1 trillion number, and which they have held since we've been between $15 to now $35 trillion worth of debt. So their percentage of contribution towards our long-term economy has actually declined. So if we look at all of that together, we continue to see an eating away at the power of the dollar from the standpoint of economics, whereas the power of the dollar from the standpoint of geopolitics still remains, and as a currency from that standpoint still remains high. And I think we'll see more chips at it when the Fed starts reducing rates just from the sheer standpoint of exchange values and a weakening from that standpoint. But it has maintained its geopolitical edge in times of uncertainty that it has had. And that's why there's a lot of factors in terms of how it's shifting. I believe the Fed will cut rates this year. Last year, I think when we spoke, I thought that they would have some sort of a cut or pivot to monetary easing or accommodative policy in the second half of this year. So I still do believe that, and I believe that after what they said in December about potentially cutting rates as well. This year, I never really aspired to the idea that it'd be March or May or June even. I do see the possibility of a July cut, and I know that's becoming less and less popular, and I adhere to that simply because what we saw last time and in the recent FOMC minutes was that they made good on their promise to talk about reducing the pace of quantitative tightening. So instead of letting $60 billion per month of securities roll off their books, well, 60 billion of treasuries, 95 billion if you throw mortgages in there, rolling off their books, they cut down that amount to 25 billion per month. And what does that mean? It means, first of all, it's really expensive to service our debt. The Fed is losing money every single day because it is not receiving as much interest on the debt banks are holding with it that it has to pay out to the Treasury Department. So it has something called negative remittances happening, and that's accumulating. So their book looks bad. We have a lot of debt. The debt payments that the country is making is large, and therefore they pivot a little bit more accommodatively on their quantitative tightening policy. That's why I think they're going to ultimately, in July or the following meeting, also pivot on rate policy. Now, Powell talks about inflation all day long, how it's not there yet, it's not 2%, he feels bad about himself, they can't, But the point is, they cannot control inflation. And the reality is, from a supply side perspective, whether it is in gas prices, oil, corn, wheat, coffee, chocolate, copper, silver, gold, you name it, they literally have no control. Even in housing and rents, which are predominantly financing based, they have no control. Rents have only escalated, housing's dipped a bit, but that's also a bit of a seasonal thing. They've really had no control over actual inflation, except from an incidental perspective, which is that inflation has somewhat gone down during the period, incidentally, I believe, with them raising rates. All of this, I think they need to process and will very soon, as they've already moved to a more accommodative process on their books. And I think what they're going to say at the next meeting, if not the following one, or if not at Jackson Hole in August, is that the economy is slowing down. Powell did brush that aside at the last Q&A. He didn't really get into the fact that our GDP is now growing at 1.6% last quarter. But I think what's going to happen is they're going to look at the relationship between inflation and economic growth. They're going to see economic growth slowing down, the labor market sort of slowing down to stabilizing to staying the same, debt increasing, their losses growing, and I think that's going to create a rate cut, 3 rate cuts this year. I still think we're going to see that. Their mandate never included a 2% band, and they've been very hesitant to back away from that band. Their mandate includes price stability, and they've been very obstinate about actually analyzing the relationship of price stability to a slowdown growth to what the cost of high debt is, and therefore just been focusing on inflation. And I think there will be more internal conversation, just like there has already been, and we've seen evidence on with their asset book about looking at other factors. Still going with the whole inflation's not where we want it, it's not 2%. All of that can continue, so they can sort of save face on that. It remains part of their dual mandate to control prices, but because they can't, and because other instabilities could arise because they can't, for example, a slowing economy or labor force, they do have the room, if they choose to maintain or to reduce rates, but still maintain this idea that they care about inflation. That definition, that 2% number is basically, is an artificially agreed upon number back in the Ben Bernanke days. Not set in gold. It's not a law. It's something Powell has definitely, sort of held tight. But I think there's forces inside the Fed that may come to bear on that idea, because again, we can't actually control the price of resources. Inflation is largely controlled, at least physical inflation, asset inflation, natural resource inflation, commodity inflation, by literally what's going on in the demand or the constrictions to demand and supply in the world. I'm very much of the opinion that yes, monetary inflation is one side of the equation. Having M2 go up or down, that's something the Fed can control. Flow of money in the system, that is one form of inflation, again, of monetary inflation. But physical inflation, product inflation, resource inflation, is something I think we have to just realize is part of the mechanism of a world that is growing and is developing. What we've seen in the last figures, for example, with China, with the above 5% growth again, and that's a quarter, but it's pretty consistent without going down relative to where they've been. They require supply of commodities that they have a lot as well. They have lithium, they have different products, but they require commodities to build things. They require energy resources that they can't produce. That they import. So there's a global situation where you've got growing economies that requires resources, and they are going to be subject to supply and demand factors and change, whether that is more crisis in the Middle East, whether that, those are floods in right now in Brazil, or whether they come this, sort of again in areas of the United States or other parts of the world, whether that is ongoing conflict with, Ukraine and Russia, and whether that's ongoing conflict between Taiwan and China. I mean, there's just a lot of areas in the world that are involved in places where there are a lot of import and export of actual supply of commodities and those chains, and those are impacted by events. I think that what we're seeing is a real height of consumer debt per person, of national debt in terms of not the overall level of treasuries, but the fact that the Treasury Department can't even rely on remittances from its own Fed, and the Fed's operating at a loss. These are things that have never happened in our history. And if we look at the regular person on the street, actually, retail is kind of, puts them in as a consumer perspective, but someone with real bills and real debt. There is a squeeze right now going on in terms of debt. And what happens when you can't borrow more because you can't afford to pay, or you default, or you go delinquent on the debt you already have, you break. That's the same thing with a corporation. That's the same thing with a human. Now, the United States isn't going to break because it's the United States and it can issue debt forever. But from the standpoint of a person on the ground, their own buying power, I think what we're seeing is they have been strong, but they've been strong on debt. And you cannot be strong on debt forever. And when that does break, that's when consumption goes down significantly. That's when delinquencies go up. That's when these office space, these open office spaces and commercial real estate has another bout of negativity. That's when banks start to close and have more problems. So there is this potential redomino effect of debt being pushed beyond its brink. I always keep an investment in gold and in silver and in copper in terms of the sort of precious metal wealth and industrial metal mechanics. Also nickel, also battery storage companies, because I think a lot of the technologies that are going to be driving our energy transformation going forward, and all the factories that are being even created for semiconductors, EVs, whatever you have, the data centers for clouds, all of that require not just more energy powering, but better battery storage. So I see that as an interesting area. And I think the commodities that drive some of our energy needs, uranium and the nuclear nuclear space I'm still positive about, as all of the geopolitics and all the needs for energy between traditional and sort of alternative sources reside in the nuclear space. So I see that continuing to grow globally, and well-positioned uranium mining companies and processing companies to benefit from that. And also on the rare earth side, I think from the standpoint of looking at where we are going as a world, from a standpoint of economic and technological development, AI, and all of that in our daily lives through defense of countries, we are going to have more need for the rare earth space. So I have been involved in looking at those and getting involved in that area as investments. Right now, they're very attractively priced because no one's really paying attention. But I think that's actually, like it was with uranium a year and a half ago, I think a good opportunity to invest for the long term.